Summary of The Big Short, Inside the Doomsday Machine by Michael Lewis. Michael Lewis's The Big Short, Inside the Doomsday Machine offers an in-depth exploration of the events leading up to the 2008 financial crisis. The book delves into the complexities of the financial markets and focuses on a group of outsiders who saw the collapse coming and took action to profit from it. Through a combination of narrative journalism and character-driven storytelling, Lewis makes a highly technical subject accessible and engaging. The prelude to the crisis. The story begins with a background on the housing market in the early 2000s, which was booming due to an unprecedented rise in subprime mortgage lending. Subprime mortgages were loans given to people with poor credit histories who were unlikely to repay them. Banks and financial institutions bundled these risky loans into mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, which were then sold to investors as low-risk, high-yield investments. The book highlights the widespread belief that housing prices would continue to rise indefinitely, leading to a false sense of security in these financial products. The major players in the financial world, including investment banks, rating agencies, and regulators, were either oblivious to or willfully ignorant of the dangers inherent in these investments. The key players. Lewis introduces a cast of unconventional characters who realized that the housing market was a bubble waiting to burst. These individuals, often considered outsiders or misfits in the financial world, saw the impending disaster and devised ways to bet against the housing market, hence the term short. 1. Michael Burry. A former neurologist turned hedge fund manager, Burry was one of the first to recognize the problems in the subprime mortgage market. He discovered that many of the loans in MBS and CDOs were likely to default and decided to short them by buying credit default swaps, CDS, against these securities. Despite skepticism from his investors, Burry's analysis proved to be correct. 2. Steve Eisman. A blunt and outspoken hedge fund manager, Eisman also saw the flaws in the subprime mortgage market. He was appalled by the practices of the mortgage industry, particularly the way lenders preyed on vulnerable borrowers. Eisman shorted the subprime market through CDS and was vocal about the corruption and greed he observed. 3. Greg Lippmann. A trader at Deutsche Bank, Lippmann was one of the few insiders who recognized the potential for profit in shorting the subprime market. He played a key role in spreading the idea of shorting mortgage-backed securities to other investors. 4. Charlie Ledley, Jamie Mai, and Ben Hockett. These three men ran a small hedge fund called Cornwall Capital. They were initially inexperienced in the financial markets but quickly grasped the scale of the impending disaster. They found a way to bet against the most toxic tranches of CDOs, leveraging a small amount of capital into massive profits. The mechanics of the short. The book meticulously explains the financial instruments that were at the center of the crisis, particularly CDOs and CDS. A CDO is a complex financial product that pools various loans, including subprime mortgages, and divides them into tranches with different levels of risk. The riskiest tranches offer higher returns but are the first to absorb losses if the underlying loans default. Credit default swaps, on the other hand, are essentially insurance policies against the default of these securities. By purchasing CDS, the key players in the book were betting that the subprime mortgage market would collapse, and when it did, the value of their CDS would skyrocket. Lewis details the opaque nature of these products and how they were sold to investors who often didn't fully understand what they were buying. The banks, rating agencies, and financial institutions all played a part in perpetuating this system, either through greed or negligence. The unraveling. As the housing market began to decline in 2007, the subprime mortgage crisis quickly spiraled into a full-blown financial meltdown. The key players in The Big Short watched as their predictions came true. The value of mortgage-backed securities plummeted, leading to massive losses for the banks and investors who had bought into the idea that housing prices would never fall. The book highlights the failures of the regulatory system, which was supposed to protect the financial markets from such a collapse. The SEC, Federal Reserve, and other regulators were either asleep at the wheel or complicit in the actions of the financial institutions that caused the crisis. As the market unraveled, the key players in the book made billions of dollars from their bets against the housing market. However, the victory was bittersweet, as they watched the global economy descend into chaos, leading to widespread unemployment, foreclosures, and a loss of public trust in the financial system. The aftermath. Lewis doesn't just focus on the financial windfalls of the few who saw the crisis coming, he also delves into the broader consequences of the meltdown. The book paints a grim picture of the aftermath, including the government bailouts of the major banks, the collapse of Lehman Brothers, and the economic suffering that followed. The author also criticizes the lack of accountability in the financial industry. Despite the massive losses and the role that many institutions played in creating the crisis, few individuals were held responsible. The book suggests that the same practices and attitudes that led to the 2008 crisis could easily lead to another financial disaster in the future. Review of The Big Short, Inside the Doomsday Machine. Michael Lewis's The Big Short is a masterful work of narrative nonfiction that brilliantly captures the complexities and absurdities of the financial markets leading up to the 2008 crisis. Through detailed character studies and clear explanations of technical financial concepts, Lewis makes the story both accessible and engaging for a wide audience. Strengths. 1. Character-driven storytelling. One of the book's greatest strengths is its focus on the quirky, often eccentric individuals who saw the crisis coming. By centering the narrative around these characters, Lewis humanizes a complex and often abstract subject. Readers are drawn into the personal journeys of Burry, Eisman, Lippman, and the Cornwall Capital team, making the financial crisis feel more tangible and immediate. 2. Clarity and accessibility. Lewis has a unique talent for making complex subjects understandable without oversimplifying them. He takes the time to explain the intricacies of financial instruments like CDOs and CDS, ensuring that readers who may not have a background in finance can still grasp the gravity of the situation. 3. Critique of the financial system. The book serves as a scathing indictment of the financial industry and the regulatory bodies that failed to prevent the crisis. Lewis doesn't shy away from exposing the greed, corruption, and incompetence that allowed the bubble to grow unchecked. His critique is sharp and well supported by the evidence he presents. 4. Engaging prose. Lewis's writing is sharp, witty, and often darkly humorous. He has a knack for capturing the absurdity of the situations he describes, making the book not only informative but also highly entertaining. Weaknesses. 1. Narrow focus. While the book does an excellent job of telling the story of the key players who profited from the crisis, it doesn't spend as much time on the broader social and economic impacts of the meltdown. Readers looking for a more comprehensive analysis of the crisis and its aftermath may find the book somewhat limited in scope. 2. Lack of diverse perspectives. The book primarily focuses on a small group of white, male investors. While this reflects the reality of the financial world at the time, it does mean that the book lacks a diversity of voices and perspectives. The experiences of those who were most directly affected by the crisis, such as homeowners and working-class families, are largely absent from the narrative. 3. Moral ambiguity. The book raises important questions about the morality of profiting from a crisis, but it doesn't fully explore the ethical implications of the actions taken by the key players. While Lewis clearly admires their foresight and ingenuity, he doesn't delve deeply into the moral complexities of their decisions. Conclusion. The Big Short, Inside the Doomsday Machine is a compelling and important book that offers a unique perspective on the 2008 financial crisis. Michael Lewis's ability to make complex financial concepts accessible, combined with his engaging storytelling, makes this a must-read for anyone interested in understanding the causes of the crisis. While the book has some limitations in scope and perspective, it remains a powerful critique of the financial system and a cautionary tale about the dangers of unchecked greed and corruption. Whether you're a seasoned finance professional or someone with no prior knowledge of the subject, The Big Short is likely to leave a lasting impression. It's a story of human folly, ingenuity, and the often blurred line between the two, told with wit, clarity, and a deep understanding of the financial world.